Thank you, Mr. Chairman. Great hearing and some very similar and common themes, actually, from all of you that have taken the time to testify today. There is a question right now, knowing that debt is an issue and it's a drag on our economy. I want to dive into this a little bit deeper with Dr. Holtz-Eakin, but it absolutely is an issue. The question is sort of how urgent of an issue is it right now? I know that Senator Gregg had a column recently in the Hill from February 25th, and how the window of opportunity is closing. Mr. Chairman, if I could just submit that for the record, that would be great. And also mention the President, just yesterday in an interview, he actually said that we don't have an immediate crisis in terms of debt. He said for the next 10 years we are in a sustainable place. And that's kind of an interesting comment to me. I think CBO kind of backs up. We've got a serious growth gap now. There's a drag on the economy in terms of having a report that says debt held by the public is projected to remain historically high relative to the size of the economy for the next decade. And already such a debt would increase the risk of a fiscal crisis, during which investors would lose so much confidence in the government's ability to manage its budget that the government would be unable to borrow at affordable rates. And what is clear, there is this correlation between high levels of government debt and slower growth. And Dr. Holtz-Eakin, you didn't touch on it in your oral testimony, but in the written testimony you did talk about this 1 percentage point penalty. And can you just talk a little bit real quick on that based on your testimony regarding that 1 percentage point penalty when you're at a certain level above 90% of debt and the drag on the economy? And I should ask you this too, do CBO's projections of employment and income growth, do they fully account for the loss imposed by slower economic growth in your view?
Well, I mean, the empirical finding, this is not my finding, but this is out of the literature, is that highly indebted countries, over 90% of GDP gross debt is the measure of debt used here, pay about a 1 percentage point, that's the median estimate, penalty in growth per year. And often the question is sort of how does this happen miraculously that we grow more slowly? But if you think about where we are with dramatic levels of debt, over 100% of GDP, and projections that show an unsustainable trajectory, if you don't make a commitment to control spending, then what have you said to the world? You've said, well, if you want to locate here or hire here, expand here, then you face two futures. Future number one is where we don't do anything. We don't fix the spending, we don't fix anything, and we hit a financial crisis. It's not exactly a pro-growth policy. Or future number two is one where we try to tax our way out of this problem. And that's utterly detrimental to growth, particularly given where we are. And so it's not surprising to me that heavily indebted countries, particularly when you get out in the tail where we're headed, have bad growth problems. It's a terrible signal to send. And so that, I think, it merits some fixing. Now, I just want to say, there's this counter-argument that says, no, 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 we want to spend now, stimulus. These aren't as, I'm not a big fan of that, but they're not as in as big a conflict as you might think, because if we do the right reforms that everyone here has talked about, go where the money is in the mandatory spending, you can take the pressure off the discretionary side. You don't have to have discretionary austerity, and we can do a lot better.
Yeah, I would concur. That would be the right direction. Let me just ask this question for everyone on the panel real quick, because it seems to be almost universal in the testimony that in these bipartisan plans we need, part of the focus should be on focusing on fixing the tax code, right? And economists call for lowering rates, especially the corporate rate, broadening the base, eliminating loopholes. However, at times at the Capitol, most of the discussion has been centered around on boosting revenue as a part of the existing code from reforms. Should the discussion about higher revenues focus on reforming the tax code to spur higher economic growth levels, or should it be more focused on getting more revenues out of the existing tax code? Senator Gregg, we'll just go right down.
I think Simpson-Bowles got it right on this point. We reduced deductions and exemptions so that we generated $1.1 trillion of revenue every year. We took $1 trillion of that and reduced rates. So the rates under Simpson-Bowles were 9, 15, and 23% on the individual sides. We took $100 billion and reduced debt. So over the 10 years of the Simpson-Bowles $4 trillion number, $1 trillion came out of revenue and $4 trillion came out of was represented as being savings. But the purpose of the tax reform in Simpson-Bowles was to create a tax code which would energize massive growth, where people would invest for the purposes of return rather than for the purposes of avoiding taxes. And as a result, you would not only get the static number of $100 billion of more revenue coming into the Treasury, but you'd get an actual dynamic number of much more than that.
Dr. Rivlin?
I think, fortunately, it's not a choice. If we do the right thing on reforming the tax code, we'll have more revenues, and we need them.
I agree with that. I think one of the lessons here is something the Senator said earlier, and I want to emphasize it. If you lose sight of good policy in the effort to get the right numbers, this is a bad exercise. A tax reform is good policy. It will cause growth. It will also generate revenues.
Congressman, I think you should be more bolder on taxes, value-added tax, shift from taxing income to taxing spending. Actually, there's a lot of agreement across the political spectrum that that's the right general idea, but there's very little agreement that you want to go anywhere near VAT. And just if I could add to what Dr. Holtz-Eakin said about the debt and how much time do we have, which is a great question. We have no idea. It depends not just on us, it depends on the world. We are the world's #1 reserve currency. If the world shifts in its portfolio preferences away from the dollar towards, I don't know, the euro, the renminbi, some other currency, other countries would like that role, then the time frame is much shorter. If we stay #1 in this specific reserve currency sense indefinitely because the Chinese blow up their financial system or the Europeans fail to turn around their sovereign debt, then we have a lot more time. Nobody knows the answer to that question. We should start now. We should not act precipitately or in a way that damages ourselves. We should set ourselves on a course where people say, yes, the Americans have got their fiscal affairs in order looking out 2, 3 decades. Thank you.
Thank you.
Great. Thank you, Representative